Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update. Today is Friday, January 6th. We did record a video last week and had some just unexpected audio difficulties. We debated whether we should send it out anyway and decided against it. It just would have not been a pleasant experience for everyone. So we're going to cover what we produced last week and as well bring in a little bit of what's happened in the early part of 2023 for this update. And then we'll be back next week with our regularly bi-weekly scheduled video. Well, in wrapping up 2022, it was a difficult year. I think a lot of investors are not sorry to wave goodbye to 2022. It was probably the most difficult year for investors in a long time, not just in the sense that the stock market struggled, but unusually it was coupled with one of the deepest drops in the bond market as well. And that made the typical, more commonly used balanced portfolio a very difficult year for that approach. Now, we feel fortunate that we built models to help us navigate through those types of markets. And we believe they worked very well in the sense of helping to preserve your wealth during 2022. But 2022 now is in the rearview mirror. We set our sights on 2023. As we move into this year, not a lot has changed with our models and proprietary indicators. We continue to have some conflicting signals with one of our key models, the PAS market model, still on a buy signal. That came into effect right at the end of November. The market struggled a bit since then. It hasn't really been able to catch a trend, and we'll take a look at our overbought, oversold indicator in a minute, and I think that will help to visualize what's happened since the buy signal. So buy signal in the market model, but coupled with still a recession warning signal from our economic models, and none of that's changed. In fact, we did get the update for November, and everything's still pointing to the downside. So no material change from an economic standpoint. So moving into our PAS dashboard, you could see no significant changes to speak of. The arrows are pointing out that they speak to the market model. Specifically, the buy signal came on November 30th. So we are now 24 business days into this signal. However, if we look at the overbought, oversold indicator, we're going to pretty clearly see that the market index has not been able to gain any traction. It's been kind of hugging the lower end of the bull trend channel, every once in a while moving out of the bull trend channel. Today's a solid day in the market, so we might move back into the middle or so of the channel. But this is fairly unusual if this is going to be a successful buy signal. It's still early, and anything could happen. Remember, we're still seasonally in the strong period in the market. Fourth quarter of a midterm election year and the first quarter of the following year are the two strongest back-to-back quarters in the presidential cycle. So we still have that wind at our back, and that could help support the market as we move further into January. However, if the market can't begin to gain some traction soon, it's possible that our market model moves back to a sell signal, and we would then move back to maximum defense in our strategy. I want to start out by reviewing some major asset class performance for 2022. And I think this scatter chart really put into perspective the difficulty in the markets in 2022. You could see 2022 is right here in red, and what we're looking at is the performance of U.S. stocks on the bottom axis, the performance of U.S. bonds on the vertical axis, and this is going all the way back to 1871. 2022 is definitely an outlier year for the balanced portfolio that carries a mix of stocks and bonds. It's rare to see a 20% or so drop in the U.S. stock market, coupled with a 15 to 20% drop in the U.S. bond market. In fact, in that time, which I guess covers, 150 years or so, that's never happened before. Typically, when the stock market is struggling, the bond market at least is carrying its weight. Now, there have been a few other instances with negative performance in a calendar year, but nothing to the extent of 2022. So that really threw a wrench into the common, passive, diversified, balanced portfolio of a 60-40 or 70-30 or whatever type of blend between stocks and bonds. Diversification into bonds did not provide the downside protection that it's expected to do. So here's another way of demonstrating the stock and bond performance and looking at it, how far they both dropped off of their high. Purple line is the MSCI All Country World Index, a global stock index. The gold line is a Bloomberg Global Aggregate Bond Index, so that's global bonds. And the first takeaway is bonds peaked earlier than stocks. They peaked, in fact, very early or 2021 or late 2020 on a global basis. They dropped 20% to the end of 2022. And the global stock index dropped about 18% from its high, which came in just the first couple of days of 2022 to the end of 2022. Let's add in the Vanguard Balanced Indexed Fund, which is that blend of stocks and bonds, and you could see a 17% drop. Now, the difference there is Vanguard's is not a global blend. It's a U.S.-only blend. But nonetheless, you could see that the diversified approach had a significant drawdown in value, whether it was heavier in stocks or heavier in bonds or that balanced blend. There was really no place to hide from that perspective in 2022. So let's isolate the equities for a minute and look at both the global and S&P 500 now being the gold line. Very similar performance in terms of drawdown from their high to the low in October and how they finished the year with both a right around an 18% decline. Let's add in the developed foreign markets, and you could see about a 16% decline. So held up a little bit better, particularly towards the end of the year. We're going to talk about the foreign markets a little bit later in this update, so please stay tuned for that. The foreign emerging markets, a bit of a different animal there. They were down close to 30%. And finally, I want to bring in and isolate in the pink the emerging Asian markets, which were down 34% off of their high. And what's more unusual than that is they put in 2 consecutive down years, which is pretty rare for a major asset class to do. But we did have a few of those, and we're going to talk a bit about those asset classes. For example, gold was down 2 consecutive years in a row, not nearly as much as the emerging Asian markets, minimally, but still very rare to see that happen. Bonds, high-quality bonds, long-term bonds, the treasury bonds, aggregate bonds had a negative 2021 and a negative 2022. That's pretty rare as well. Let's take the foreign markets out and let's bring in the Dow Jones Industrial Average, which was down 8%, obviously much better than the S&P 500 or the global stock index. We're also bringing in now the NASDAQ 100 index, which really struggled, down 33%. These are the big tech stocks for the most part, and you could see the mega cap U.S. stocks were extremely poor performers and actually finished the year very close to the lows, whereas these other asset classes had pretty nice bounce, a little bit of a pullback towards the end of the year, but well off of their highs. Not so for the NASDAQ. Now we're looking at U.S. growth stocks in the blue, which is similar to the NASDAQ, down about 30%. U.S. value stocks only down about 6%. So if there was one place to hide, at least from a relative standpoint, value stocks were still down on the year, but down much less than growth stocks. So let's go back to looking at the asset class charts and the returns. And now I'm bringing in the Bloomberg Commodity Index. And, commodities held up extremely well through the early part of the bear market, where stocks peaked early in the year and started dropping. Commodities continued to hit new highs until the middle part of the year. But then they really caught up to stocks in terms of how much they dropped off of their highs. Now, they still were up on the year and performed much better than stocks, but nonetheless, a big drop occurred. And that's something that we tend to see, and one of the reasons why when we get sell signals with our models, we try not to hide in certain asset classes that appear to be strong at the time, because oftentimes when a bear market takes hold, it brings all asset classes down that have some correlation with risky asset classes like commodities and stocks, for example. And in fact, what often happens is the ones that hold up well in the early part of the bear market end up dropping the most towards the end of the bear market. And that's what we saw happen with commodities in 2022. Let's take a look at some industry sectors using the S&P here as a benchmark and bring in first the weakest of the sectors. Communication services down 44% off of their high. Started dropping earlier than the S&P did. Consumer discretionary sector down 39% off of its high. And technology down 29% off of its high. Now, if we put that on a 2022 full year chart, you could see those sectors were down significantly. Energy was the only sector in the S&P 500 that was up, and up strong, 65%. Really, most of those gains came in the early part of the year, but held those gains through the second half of the year. So when it comes to stocks, energy was really the only place to hide from a sector standpoint. Certainly some dropped less than others. But the most popular sectors, communication services, consumer discretionary, technology, they got hit the hardest. And turning over to the bond side of the market, here's the Bloomberg U.S. aggregate bond down 13% last year. But all categories of bonds for the most part. We could add in corporate bonds. We could add in corporate high-yield bonds. We could add in municipal bonds. We could add in treasury bonds. It really didn't matter. Certainly treasury bonds got hit the hardest, but all of these bond asset classes. So even diversification within the bond market didn't pay off last year. Well, as you could see, a pretty thorough demonstration on just how difficult 2022 was from a stock bond type of investment strategy. There was really no place to hide, and we feel just very fortunate to have built the models that we did to withstand these types of market conditions. Wealth preservation, we believe, was the top concern in 2022. And we're not sure if this bear market's over. As we said, there's some conflicting signals in our model right now. If there's another leg down, wealth preservation may become very important once again here in 2023. On the other hand, there's always the potential that we've seen the end of the bear market and opportunities begin to be presented. But I want to end this update on a bit of a positive note. We've been talking a lot on the downside and negatively about the market because our models have been negative, and that's what we should do. However, there are opportunities developing, we believe, and we just have to keep our eyes open. Let's take a look. This is an interesting chart that shows investment themes by decade. Every decade experiences a boom in some asset class. The decade that just concluded in 2020, it was American megacap stocks, far and away the best place to have your money. However, once that boom is over, it usually takes a long time for that previous asset class that led to become strong again. I find a lot of investors waiting for the 2020 bull market winners to come back into leadership role. It's not likely to happen, at least not for a durable period of time. They certainly will have periods of strength because they've dropped so much. But oftentimes those former leaders struggle for the next decade, sometimes longer, before they come back into favor. Prior to 2010, we had a lost decade in the U.S. market. From 2000 to 2010, the U.S. stock market experienced no growth. In fact, it was down during that 10-year period. But not so for emerging markets and commodities. They experienced a strong decade. Since then, though, emerging markets and commodities experienced a very weak period. In fact, emerging market stocks peaked in 2011, and they haven't grown for the most part during the last decade. But that was a lost decade for the U.S. market, not so for the emerging markets. Similarly, in the 1970s, that was a lost decade for the U.S. market. Once again, emerging markets and commodities boomed during that time. So you see, there's this rotation that takes place, sometimes not on a short-term basis, sometimes on a very long-term basis. We've talked a bit about how we expect low returns in the U.S. stock market over the next decade. We do. However, there are going to be opportunities developing. And one of our jobs as an investment manager is to keep our eyes open for that and to be flexible, to be able to rotate into the area of strength. What could that be? Maybe it's value stocks. We saw how value stocks are outperforming growth stocks. Growth stocks had a great last decade. Maybe it's value stocks this decade. Maybe it's energy stocks. We see how energy stocks are doing so well, really the only sector that had any positive performance last year. But there's another asset class that I think is a bit forgotten that could experience a comeback. And that's the foreign markets, just in general terms, because the foreign markets have experienced a lost decade. Now, this is a chart that shows the MSCI US stock index, the blue line, to the MSCI World Index without U.S. stocks, the gold line. The chart starts at the beginning of 2008, runs through the end of 2022. And what we simply see is the foreign markets have had no growth for 14 years. Meanwhile, the U.S. market at its high was up 220% over the previous high. Obviously, a drop off of that high with the latest bear market. But there's a stark difference, and that's a major shift in asset class performance there during that last decade to 14 years. Now, additionally, we see the price-to-earnings ratio for the MSCI EFA, which is the developed foreign markets, compared to the S&P 500, is about 30% lower. So there's better value in the foreign markets. Typically, these track each other for the most part. Right now, we're at the widest spread that we've seen in quite some time. So there's better value in foreign markets. They've gone through a decade plus of no growth. This is one we want to keep an eye out on, and we'll be monitoring it with our asset class indicators like we do growth versus value. We have one that compares the U.S. to the foreign markets, and we're seeing a little bit of signs that there's a shift taking place, but it's early. We'll continue to monitor that and keep you posted in future updates. Well, that's going to wrap up this update. Apologize again for the technical difficulties we had last week. I want to wish you a happy 2023, and we'll be back next week with the regularly scheduled bi-weekly update. Thanks for watching.